I'm going to talk about measuring uncertainty with text. To be honest, I'm going to talk a little bit about measuring uncertainty more generally. So I'll kind of try and motivate why we should care a bit about this, and then talk about how to measure it, different approaches. So here we go. So, why do I care about uncertainty? In fact, I'm going to stop sharing for just a second to say, if you have any questions, feel free to unmute and just speak. It's really weird, as everyone knows, teaching on Zoom, it's not ideal. You can't see people's hands or stuff, but I much prefer people just unmute. It's much better. So please don't feel it's rude at all. I'll try and pause, but I'll probably get too excited and forget about it. So, if you want to ask a question, just unmute. I'd actually really appreciate it, because it's a chance to slow down. I've drunk too much coffee already, so that's going to speed me up. So questions are great. I won't read chat. It's kind of hard to read chat, but just unmute and say something. And in fact, Tarek, if you have a question, or Jesse or Matteo, if you're around, feel free to do the same. It's probably it's good. It will set the scene for like breaking and asking lots of questions. Okay, so I'll go back. So there's a kind of practical view uncertainty matters. Okay, click it. Here we go. So, if you go back, here's a piece by Olivier Blanchard, came out in The Economist. It was during the global financial crisis, 08-09, claiming uncertainty was a big issue. Here was a piece after Trump. Trump, as I'll show you later, is like a one-man uncertainty shock, generated uncertainty. As you can probably figure out, I'm no Trump fan. But I'm going to stay off politics, but just in terms of uncertainty, he wasn't really, ideal. There's Brexit, another, horrible political, event in the UK, also generated a lot of uncertainty, not just for the UK, but for the European Union. And then obviously coronavirus, and everything that's going on. So, I always joke for some people, particularly if you're in Stanford, the best evidence that uncertainty is important, particularly if you're someone like John Cochrane or John Taylor, that is to the more Republican end of the spectrum, is that Paul Krugman thinks it isn't. So there's a set of people that define their views as the exact opposite of everything that Paul Krugman says. So Paul Krugman, oddly enough, has been talking about, more in the global financial crisis. He was saying uncertainty doesn't matter. And it was when the Republicans were beating up on Obama and claiming that Obama is creating loads of uncertainty. You notice the dates, like 2011. Paul Krugman starts off polite, varieties of uncertainty, asymmetric, and then just goes straight to the kill. Culture of fraud, the uncertainty scam, another bad three bites the dust, and on and on and on. So I should say, for the reason Krugman raised this issue is kind of legitimate enough. He was worried about cause and effect, and he was worried about measurement. And you notice this is the last thing I have is 2013. Once the Republicans stopped being the opposition, Krugman's moved path, and actually recently he's, written some things claiming uncertainty is important. So maybe, I don't know, the end. Those that don't agree with Krugman maybe have changed their minds too. So if you want to measure uncertainty, how do you do it? And I'm going to talk, the first and the third are non-text-based measures, and the middle one is text-based. And this middle paper is really how I got onto this topic, and then it will lead into very much to what Tarek is talking about and work we're doing together and work he is doing. So this is aging me, but I did my PhD from 1996 to 2001. I'd like to think that was not that long ago, but it was over 20 years ago, and I completed 20 years ago, I completed my PhD. I worked on uncertainty, and back then the measure I used was, well, initially I looked at stock market volatility. So the idea of the stock market is super volatile, is bouncing up and down. You may think that, the world is very uncertain. Turns out there's probably a better measure. It's called the VIX. It's the 1 month ahead implied volatility. So what the VIX does is it looks ahead. It's like traded all the time. There are, thousands of traders. It's an index of looking ahead. So basically the VIX, minute by minute says, well, look, over the next 1 month, how volatile do we think the stock market's going to be? Turns out that's probably quite a good indicator of uncertainty. The stock market's bouncing up and down all the time. There's probably, a lot of uncertain things going on. News is coming in. If it's very flat, it's probably relatively calm. So if you look here, you can see this is going back to 2015. It spikes up around the election, but it surged around coronavirus. If I took it back, it surged around the global financial crisis. It actually surged around 9/11. The 20th anniversary of 9/11 coming up. I was actually talking to someone about that. It surged, this thing surges after big shocks. So The pros as a measure is it's daily available real time back to 1990. So it's fantastic if you have a measure, particularly if you're for policy or if you're doing finance, to have it daily and have it available real time. So you can go and look today. I haven't looked this morning, but I downloaded this yesterday. So I think it's pretty, it's pretty recent. You notice it just spiked up. People are nervous about what the Fed is going to do. Is the Fed going to stop buying assets? Is it going to start putting up rates? You can look at it every day. The downsides is it tends to go up in recessions, and it's also very sensitive to financial crises. So, banks, tech is heavy in the stock market. Things like manufacturing and retail are relatively light, so it's stock market focused. You also can't get this for a lot of countries. So this is the US VIX. You can get similar things for the UK over, shorter time periods of Europe. If you want to say, look at uncertainty in Ghana, or the Ivory Coast, or Vietnam, or even Australia, I'm not sure how easy it is to get implied vol. So this is great for people looking at American data daily back to 1990, but it's kind of more limited if you want to look more broadly and have a different perspective. So happy to pause. I'll go silent. If there are any questions, feel free to unmute.
Hi, my name is Anshu. I'm from Princeton. Maybe this is a dumb question, but why is it a downside that the VIX contains recessions and financial crises?
It's a great question, actually, and maybe it isn't. I mean, there's an old literature on the leverage effect on volatility. So just to explain, so probably you guys know this, but just to go back to basics, just in case anyone's not aware of this, but if you think of a company that's financed by debt and equity, imagine your company is financed by, 50% debt, 50% equity. If business conditions go down, your debt repayments stay the same. Therefore, your equity falls and becomes more volatile. So equity is the residual claimant, tends to be more volatile in recession. So there's a very old paper by Bill Schwer in 1990 asking, firstly, spotting that volatility tends to rise in recessions and saying, is this all the leverage effect? So when companies become worth less, is it the case that leverage drives up volatility? He argues that's only about 10% of it, but there is a bit of a natural bias in recessions to push up volatility more than what's truly there. So I wouldn't say it's a big issue. And you're right, my work has kind of argued a bit that part of what causes recessions is uncertainty. So maybe, I agree, actually. So maybe I should, for 2022, I should downgrade that. I think the bigger problem is it focuses on the stock market, which, I was looking today, there's a piece in the Wall Street Journal about how, all these meme stocks and these traders, day traders, these folks are moving the market, and I don't think they're particularly informed about what on earth's going on. GameStop is hardly an indicator of the general economy. So that's one issue. The other issue is even if it's Wall Street traders that know what they're doing, the stock market is dominated by tech and banks. So do we really think the volatility of Goldman Sachs and Google reflects the whole economy? So you're right. The recession thing maybe is less finish. Thank you for asking as well. You definitely get the point for the first question. Okay. Anyone else? Unless there's anyone else, I'll go on. But I'm happy if you want to ask a question, feel free to mute me. Christopher.
Yeah. So I'm just curious, what kind of expectations are we trying to measure here, specifically under what measure? Because the VIX is intrinsically related to the risk neutral measure, right?
Yeah.
So is that of interest to us in the first place? I'd say, we'd probably be more interested in the actual probabilities and a measure constructed on that. Maybe you can elaborate a little bit more on what we actually try to measure.
Great. Again, great question. So later on, I'm going to come back to using surveys. We actually ask firms on physical probabilities. So you're right to ask about, in some ways, that's the ideal measure. The problem is we have survey data I'll show you in about half an hour, but it only goes back 6 years because you just have to survey firms. That's expensive and difficult. So in the absence of that, we use the VIX. And you're right, the VIX kind of combines two things. It's the quantity of risk times the price of risk. And the VIX may go up because people are very risk averse. I'm horrified. I'm really nervous about risk. Who holds the VIX? There's a lot of basically investors like pension funds, endowments, etc. And they may get terrified that they're going to lose their job. So if I come back to Anshu's question, in recessions, Imagine all these hedge fund managers have contracts that say, if your portfolio goes down more than 20%, we're going to fire you. So what happens if the portfolio goes down 10%? They get terrified it's going to go down much more. They're going to lose their jobs. They buy all these, put options to limit how much further it can go down. It pushes the VIX up. So maybe the VIX is going up because the price of risk is moving around, or because the quantity. And you're right, theoretically, the VIX is supposed to be risk neutral. In practice, this isn't really. And I don't want to get into kind of complicated details and like smiles and smirks and option pricing, but there's a bit of the price of risk in here. As if you were to set up a model, like if you were to do a dynamic model and solve a Bellman equation and figure out what the value of the firm is and have like stochastic productivity shocks, stochastic volatility, you'd see every time productivity moves around, the value of the firm goes up and down. So productivity is moving around a lot, as in there's a lot of uncertainty, the value of the firm would be moving up and down a lot. And if you think stock markets are efficient, that would show up in higher stock volatility. So there are a few leaps of faith. You're correct. You have to, believe stock markets are reasonably efficient, that it's mostly the quantity of risk, that it reflects some fundamental. So I would say it's kind of a 7 out of 10 measure. It's not ideal, and it's partly why I moved on to other measures. On the upside is the pros, is it is daily, it is free. I mean, none of us have to pay to get it. It's like on our computers going back, 40 years for free. And, I can get it for yesterday. The downside is basically it reflects market volatility around tech and banks. And that's correlated with risk, as you see here, but it's definitely not the only thing that's driving it. So yeah, there's many people that criticize the VIX over the years. It's pretty good. Again, 6, 7 out of 10 is definitely not 10 out of 10. That's kind of what going to drive me in a second to talk about text measures. So feel free to interrupt. If there are other questions, I'll move on. So what about newspapers? So here's text. So, this is a weird history, but with Scott Baker as my student at Stanford, who I work with a lot with Steve Davis, and in fact, Tasnir, who's in the group, works a lot with Scott and I. Back, I think it was like 2008 or 2009, Steve and I were like drinking coffee in the Sinesta back in the day, which is in Boston, where the MBR, Summer Institute, is held. It's like back in the day when conferences were actually in person, you could have coffee with people. And I remember saying, wouldn't it be great to have coming back to kind of answering Christopher's question, like, wouldn't it be great to have better measures of uncertainty, maybe ones that reflect what we're reading in the news? And so we started this project that's still ongoing, really, about using newspapers as an alternative way to measure uncertainty. And, this paper came out in the QJ in 2016. We have a website with data. I'm going to tell you about the process, but if you're interested offline, you can go and look at the data on the website, or in fact, Fred carries our data as well. And here's an ongoing project on stock jumps I'm not going to talk about today. But, Tasnir and, Marcus Salmon and others are involved in that as well. So how do we measure? What do we do in terms of text? Well, we started off getting 10 major US newspapers. So these are things like the New York Times, Wall Street Journal, Washington Post, USA Today. They're basically the 10, they've been long-lived and reasonably high circulation US newspapers. We did something super simple, which was we measured the share of articles in any month in each newspaper that mentioned economic or economy, and mentioned one of 6 policy words, and mentioned uncertain or uncertainty. So this is, in terms of text data, this is very simple because it's what I would call a bag of words type approach. So no, it doesn't matter whether these words are next to each other or at the opposite end of the entire, 2000 word article. We're literally just looking for the frequency, whether these words from each of these 3 combinations occur. Also doesn't matter the frequency, whether they're in the headline, first paragraph, last paragraph, etc. So in terms of bag of words, it's very simple. Is it the case that we get a tick against these 3 boxes, in which case we tag it as an EPU article? If not, we don't. And again, if there's 2 of the 3, it doesn't get tagged. It has to be all 3. So to explain, the upside of this is it's very easy in that we don't actually need the underlying article. So if you want to do something more complicated, like are these words next to each other? Are they in the headline? Are they in the main paragraph? You probably need the full text of the underlying article, which turns out to be really expensive. So to buy the full text of the New York Times, say, is enormous amounts of money. In fact, we've looked into it and given up because it costs too much. What we do is each day we fire a search request at the New York Times search page on the homepage, and it just says, search for articles using a kind of complicated Boolean string, and it just will return like 7 articles. and that's 7. And then we do a second search, which is just leave the search thing blank, and it will return 211. That's the total number of articles in that day. And so 7 divided by 211 is the share of articles that mention EPU in that day. And that is very straightforward. We don't need the underlying text. We can use search engines or things like Newsbank. As I mentioned, we divide the count each month by the count of all articles to get a share. We normalize each paper to have a mean of 1 and a standard deviation of 1 to kind of normalize these things, set the index to 100 on average up to 2010. Now, here are the 10 papers. They're all very standard papers. This is what you get. So this is the index. I've downloaded it from Fred. And you can see it looks reasonably sensible. I wouldn't say it's perfect. Like here's 9/11. Here's the global financial crisis. Here's COVID. Here's kind of Trump trade war. Here's like fiscal cliff, debt ceiling crisis, taper tantrum. I can't remember. These are all kind of events. Here's the Asian financial crisis, stock market, et cetera, et cetera. So it looks reasonably sensible. You notice compared to the VIX, the pandemic is like an order of magnitude larger. That kind of feels correct to me. Personally, I think the pandemic generated much more personal uncertainty for the economy and overall than the global financial crisis in 08 or 09. But I'm happy to pause and people can disagree. But you notice that VIX, the stock market, if anything, was more volatile in 08 and 09. Newspapers were massively more talking about uncertainty then, particularly in the depths. If you remember back to just over a year ago, March, April, May, it felt like the world was coming to an end. We didn't know how, how COVID was spread, how deadly it was, what the side effects were, etc. I mean, it was pretty scary for all of us. So this is the rough idea. And again, I'm happy to pause and take any questions on this as the basic idea.
I have a quick question about this. I'm struggling with understanding what uncertainty here means. If I am entering the pandemic and I'm hearing all these conversations around the economy, needing to stay home, is it uncertainty about my job being lost or the GDP going lower or the prices changing or trade wars happening? Does it matter in this framework or for your work what the source of that uncertainty is, or if the words you're using, which seem to be very regulatory heavy, that's not capturing the kind of sum total of it, so uncertainty, whatever that may mean, that is being processed by households? So
again, great question. The downside of this, the upside of this index, again, it's daily. We actually have a daily measure there's like about 1,000 daily national regional newspapers in the US. It's fantastic, goes back, to over 100 years because it's newspapers. The upside, the downsides is it is vague what it is. We did in the paper an audit, and the 3 main buckets is, these are all policies. So a lot of them is uncertainty over what the policy will be. Like, will Trump start a trade war with China, yes or no? Another bucket is the uncertainty over the impact of it. So what the impact of the trade war, some of them like the stimulus bill, what the impact is very uncertain of what. For example, in the coronavirus, people weren't sure how effective the Fed and the Treasuries, the Fed's monetary easing. And it turned out the Fed did, I think, a fantastic job and, averted a horrible recession. And, and then the third thing is actually uncertainty about who. So that's a lot of that's around elections, but also something about, will Jay Powell stay on, or will he be replaced by, I think, Janet Yellen or, I'm forgetting the name of the woman that, she came to talk at CEPA. I'm blanking on her name. Actually, she has a famous paper on uncertainty, weirdly enough. Does anyone remember who's the woman that's, somebody help me out. I've forgotten her name right now, but. Okay. Somebody's put it in chat. Let's see. Lael Brainard. Yeah, thank you. Lael Brainard. Yeah. She came to talk. I was one of about 6 people I had dinner with her about 2 years ago. She has a famous paper actually on uncertainty in the 90s. So that's the 3 measures. So it's a vague concept. So it doesn't perfectly map to a model. If you were to write down a Bellman equation, well, you'd be like, A, there's no policy in these dynamic models. So maybe you think, okay, the Bellman equation, policy uncertainty, maybe you allow W or R to be, wage rates or interest rates or prices to be stochastic, and then we'd have to write down a process for that. And it gets kind of complicated. So I'd say it's not structurally well-founded at all. You're right about these words. So these words were kind of a lesson to us in text to data. Then initially we thought, well, we're going to use the word policy. I mean, we're talking about economic policy uncertainty, so it seems natural to use the word policy. And we put the word policy in there. And lo and behold, and Tarek will talk about this a lot as well, it turned out it tagged a lot of really unsuitable articles. So there are a heck of a lot that talked about insurance policy, which has nothing to do with policy. There was my favorite was one that talked about, was in the sports section, talked about the Green Bay Packers, whether they'd use the rush attack on the 4th down, because it was economical with linebackers and it was uncertain. You know, it's like, that's completely nothing to do with us. So these words, it turns out, are minimized kind of type 1 and type 2 error. If one of these 6 words is mentioned, it's pretty likely it's about economic policy. And if you're having a major article about economic policy, it's quite likely that one of these guys is going to be mentioned. So that's why we went with this. But you're right, Namrata. You know, again, this is a 7 out of 10 measure. There is no, unfortunately, there is no ideal measure here. This is, the uncertainty literature is a world of lots of quite good, but, you know, definitely not perfect measures. And in fact, I should say on that, there's currently a literature called the uncertainty volatility paradox. The fact that stock market volatility is right now really low, and that this measure, I pulled this thing off yesterday, so I can get it a commentary around it. Yeah, here we go. This thing, it's kind of falling. It's, you know, 100's the long run average. It's still above 100. I'd feel right now is quite uncertain times. It still doesn't feel that predictable to me. This thing is still high, but volatility of the stock market is below average. The VIX is really low. So there's a whole literature on what on earth's going on. And, you know, these are 2 different measures supposedly showing the same thing, actually showing different stuff.
Okay, so should we think of measure of uncertainty affecting households or policymakers or traders, or should we think about them interchangeably?
You know, this is, I mean, in all honesty, this is kind of wishy-washy and vague. We called it economic policy uncertainty. It's actually been used a lot by hedge funds, banks, Wall Street. Whenever I talk to like traders, they've heard of this. They use it. I mean, it's quite weird. It's like, they normally know Scott Baker. They're like, oh, you work for Scott Baker. Because they, you know, they're like used to the Baker index. They're like, oh, you helped construct the Baker index. You know, it's like fantastic. I'm like, no, it's well, that's fine. It's alphabetical. Like, I normally benefit from the alphabet, so I can't complain. But it's normally, to be honest, just used as a general measure of uncertainty. So I'd say in practice, most people forget the P word. So you're correct. There's an old literature on households. I mean, Jan Eberly, who is like really critical to, you know, I'm a big fan of Jan Eberly's work. She did her PhD on uncertainty affecting households. Ricardo Caballero has some stuff, you know, Eduardo Engo. There's people that looked at, it's not just firms that, you know, stop investing and hiring. You also see households don't buy stuff, they retrench, etc. And this thing probably is a good index for households, because households are probably the people reading the newspaper. So, you know, on the upside, it's efficient, you know, it's quick, it comes out real time. I think it's realistic. On the downside, it's vague. It's a kind of pretty nebulous time. So Hillary and then Jingtao, then I'll move on.
You already sort of touched on this, and it might be a question that you want to come back to later instead of now. But I was wondering if you could expand a little bit more on how you pick these specific words. And it's one thing that I've sort of been confused about in my own research when I've thought about doing text-based methods, is how to pick these words.
Great. So this is going to connect. Tarek and I are very aligned on this. This will connect. I'm a huge believer in what I call human audits. So basically running search, checking what comes up and refining it. So Scott, Steve and I didn't start with these words by any means. There are a lot of words that, for example, the word tariff is not here. In fact, if you do the historical index, we have to include it. Pre-Trump, no one talked about tariffs, you know, before World War II, realistically. War is not here, in part because war tags things like drugs war, or, you know, war on terror, which isn't really that related to policy. So the way we chose them is we did a human audit. You couldn't do the scale of this, but it'd be possible to do a smaller version, particularly if you say raised some research funding and got folks, you know, you could hire probably RAs in India or something to do this, but we got people to read around 10,000 newspaper articles and a human to read it. We had this long coding guide where we defined exactly what is economic policy uncertainty. And they'd read each article and they'd tag it with a 1 if it was and a 0 otherwise. So this is a human reading it. And then we compared the human to the computer. And we actually, this is the time series, we actually had a different way of evaluating. You had type 1 and type 2 error. So I always get confused which way around it is. I don't know if anyone else can remember, but one is basically rejecting the false. What is it? You don't want to reject the true, accept the false. So the more words you have, the more likely you're to include any article on economic policy uncertainty, but the more likely you are to accidentally tag something that isn't. So there's a trade-off and there's kind of a frontier. And what we did is for every bundle of words, we plotted the type 1, type 2 errors as assessed on these 10,000 articles and basically pick the minimum combination. Again, it's not totally scientific, but these words turned out to be pretty good because there's not much accepting the false. I mean, sometimes you talk about deficit Federal Reserve, it's maybe not about, policy, but mostly these are relatively safe policy words. And mostly a major article talking about policy uncertainties like to mention one of these, but it's not perfect. So that's how we came to it. And it's an input. And you can see here, by the way, computers and humans, interesting enough, you look at the difference, they both make mistakes. So computers obviously do stupid things like the Green Bay Packers article. Humans don't read articles perfectly. So you would compare the differences. And sometimes it would be like, okay, it's obvious the computer just is following our rules, but it's not appropriate. And sometimes you'd like the humans misread the article. So they're both imperfect.
So once you have the human metric for a subset of these articles, then you iterate on words that make sense to you and see.
Exactly right. And you keep going. And, you're always easy to take pot shots. I remember Krugman attacked us once in some other piece saying, look at this article. They've tagged it, but it's not about EPU. And we're like, okay, fine. But I mean, we're not trying to do it on one article. We're trying to do it. That's why I have 10 newspapers and collate per month. And I think it's like 20,000 articles. So there is, but there is a measurement error issue. And like all data, there's measurement error, and you just have to get large enough samples, and then the error hopefully washes out. You're really looking for bias, and it's why we took the word policy out, because from human reads would regularly come up with policy, and it wouldn't work very well. Another thing we tried to do is we tried to kind of connect it to individual topics. That's also hard. Like you'd think the word war would identify military events in the newspaper. It most typically came up with trade war or drug war. So, this stuff is not that easy. Initially, it seems obvious. When you actually read tons of these newspaper articles, you find that there's a lot of terminology. Or sometimes you may get a ban. Trying to think of a ban, but, there are other things where, some band's lead singer dies or something. They're in the news and it spikes up because they happen to be called, I don't know, Federal Reserve. I try to think of, but we've seen this. Well, sports teams have tagged this. So you've got to be kind of careful the words you use.
I think I've been deputized as timekeeper. We have 15 minutes in the first session. Okay,
so why don't I keep going? So you can break it down kind of in, going ahead a bit of what's saying Hillary, you can look at the nice thing about text today is you can look at subsets. So you can say, look, it has to mention a policy word, but it has to mention one about fiscal policy. So we're going to make sure it also has to mention something about deficit, government spending, etc. Or monetary policy has to mention Federal Reserve, federal funds rate, etc. So just a broader list of words. You notice it works reasonably well. Here, trade policy was basically, nobody cared about trade policy before Trump started battling with China. It's got boring again. During the pandemic, it's all about health, but particularly fiscal and monetary policy. Again, I think the Fed has done a great job in order to be so active and keep monetary policy uncertainty moderately low. A lot of the uncertainty was around the fiscal policy and what the Congress would do. I mentioned you can go back in time. Newspapers do go back a long way. I've actually been into the archives in Stanford. There are physical, crumbly old newspapers. We have the digitized versions. It gets more problematic. I would not say the index is as good back here. Partly, we don't have the underlying text. We have PDFs, and you have to use OCR readers of the PDFs. And as somebody spilled a cup of coffee on the one from 1911, and it's not ideal. There's also only 6 papers, I think, back here. These guys, Washington Post, Boston Globe, LA Times, New York Times, Wall Street Journal, and Chicago Tribune, go all the way back. But generally, it looks pretty sensible. And if you look at these jumps, they mostly look, everything from the Great Depression to the Tet Offensive to OPEC 1, OPEC 2, etc. Here's the UK. UK, we had the horrible, disastrous Brexit vote. I oddly enough, I voted against Brexit. I was eligible to vote. But what can you do? But that generated a huge surge of uncertainty the UK is not really fully recovered from. Here's India. You can basically do any country that has a free press that you can get access to newspapers and search them, which means there's nothing for North Korea. There is no North Korean index. So we're limited. We are honestly limited to countries with a free press and how far you can go back. I mentioned it's been used a lot. Because we're out of time, I won't. But the pros of this stuff is you can get it daily, which is a big issue if you want to do finance stuff. You can certainly generate weekly or monthly indices. It goes back. It provides nice subcategories. So if you wanted to look at, say, climate policy uncertainty, you could do that. The cons is it uses newspapers. You can worry about bias. I know there's been a lot of attack on, was it mainstream media? Maybe it focuses on interesting events. The World Cup maybe pushes down other coverage. I mean, it's not perfect. Newspapers are definitely not unbiased and totally neutral, but I think it's a pretty good avenue. Again, I give it kind of a 7 out of 10. So a second approach is Twitter. Turns out you can use tweets. We just started this with Thomas Renaud. And Twitter looks just scraping a lot of tweets. It's harder work because Twitter's not a stable panel. People come and go. They get a site, Kim Kardashian tweets something or Kanye West, everyone retweets and generates spikes. But again, it generally looks similar. Again, it's a pretty good measure, and we've been trying to track this daily. A third approach is to use, again, text to data, is to use the Economist Intelligence Unit. They have these quarterly country reports. So they produce things look like, here's an example for France. It's about 30 pages. It's a relatively similar structure. And we just tag the number of times it talks about uncertainty. So in this example, it talked about it 3 times. One was about Sarkozy, what he's going to do. One is about the US, how it affects France. One is, geez, I can't even read this actually, but there's a third. It's been a while since I looked at this, but basically we're going to tag how many times uncertainty is mentioned. The nice thing about the EIU is these reports cover about 130 countries. They come out once a quarter. So we don't have a lot of text. We have 30 pages per quarter, but it's on a standardized format going back over many years. Here's a global measure. We take the GDP weighted average across all the countries they have. Kind of is trending up. It rose massively during the pandemic and dropped back down. Here's some example countries. The nice thing about World Uncertainty Index is you can look at individual countries. So I'm not claiming any of these indices are very accurate. We've only got, for each observation in Congo, you've got one EIU report per quarter. That's only 30 pages. But if you were to do a panel regressions on developing countries or globally, it's going to be a lot of data. And most of them, you've looked at these, they look reasonably sensible. So one thing we're going to show that's kind of interesting is, how the US and the UK have been massive uncertainty exporters recently. So what we do here is this looks at the global, this looks at mentions of the word uncertainty and the share across all countries that mention the US or US related words like Donald Trump or George Bush or Jerome Powell or Ben Bernanke, etc., within the same sentence. So I think it's plus or minus 15 words. And it's a measure of basically how much uncertainty outside the US is affecting other countries. So we have 140 countries roughly. We're not looking at the US, we're looking at the other 139. How often when they mention the word uncertainty in that sentence is a US word mentioned? You can see mostly not a lot. America is not a big driver of uncertainty. Lo and behold, Trump comes along and it just explodes. And the reason is Trump was not only domestically hugely unpredictable, but was sending, fears, terrors throughout the world that he'd start a trade war, there'd be some embargo, there'd be a fight, there'd be a spat, he'd, generate some kind of nuclear war in the Korean Peninsula, whatever. So you can see Trump basically exported a lot of uncertainty. We've yet to update it. My suspicion is it will fall back down again. But, the Afghanistan incident is obviously problematic, but this is at least recently is gone up a lot. The US is very causal for global uncertainty. The same is true of the UK.
Nick, just one question. Can you go back one slide? Just kind of a cool, I think kind of an interesting, interesting piece here. So we looked at something very similar using the firm disclosures, using the earnings conference calls. And it looks, as far as I recall, it looks very similar, except that the Iraq war is like off the scale high for foreigners. So foreigners complaining a lot about the Iraq war. It's a little different, actually. I'll get there later, but it's the foreigners complaining a lot about the Iraq war.
If you reweight, it might be that oil companies tend to be listed. The Iraq war is a huge issue for oil companies.
That's entirely possible, yeah.
It'd be interesting if you take your thing and sectorally reweight it, because UK and US are overweight in stock market listing, and they have a lot of oil companies. France, right, like Total F. I'm happy to come back and discuss it later. And then here's the UK. Nobody, much as I'd like to claim otherwise, basically nobody cares about the UK. up until Brexit. Then it only cares about us for bad reasons because we're, threatening to destroy the entire European Union, one of the greatest achievements, in post-World War II Europe. Thankfully, we don't. We just throw ourselves out of it, but, the EU remains. But you can see that generated a lot of global uncertainty. And there are various instances. Here's the original vote. Here's whether the UK would do deal or no deal. Here's that fiasco when they had multiple votes in Parliament. People are going to move on and hopefully forget about the UK again, and we'll be back to zero. You can look at different countries. I'm kind of out of time, I know. So low-income countries, the Economist Intelligence Unit, they mention uncertainty more than middle, then more than high. You can also, here's a big issue, come back to discussion earlier, what words, I think related to some of the questions from Hillary and Namrata, I think, and others are asking. Here's just uncertainty. That's the only word. Here was 30,000 over this point over all the text. We looked at what we called neutral synonyms of uncertainty, words that are similar. There's another 22,000 of them. Here is redoing the index with neutral synonyms. The level goes up, but the trend's pretty similar. Here's adding negative synonyms, which basically includes risk. You notice that risk comes up 3 times as much as uncertainty. So including the word risk, it is not an inconsequential decision. And notice now risk is included in red. This goes up much more strongly. I personally think that's probably not appropriate. I think, come back to Christopher's discussion at the beginning, maybe if people are more concerned with risk, maybe it's more, the growth of finance. We decided not to include the word risk in our index because it just tilts it so strongly upwards. It actually seemed implausible. But, word choice definitely matters, and you can see this very clearly here. So I'm happy to take any. I was going to talk about surveys. So the final thing, in fact, why don't I do this about 2 minutes and I'll end. So you can also get survey data. You can just ask firms. So you can say, looking ahead, what's the low, looking ahead a year from now, what do you predict for sales growth? What will be the lowest, low, middle, high, and highest percentile growth you can imagine? And firms fill out these numbers. Here's a typical firm, it's pretty narrow actually. And then what probabilities would you put against them? And they give you numbers. And then that basically gives subjective uncertainty. So we've done a big US survey. Here's what the subjective uncertainty for the US looks like. It was kind of flat. And then pandemic kicked it up and it's falling back down again. So this in some ways is, the real measure. It's subjective uncertainty for US firms looking 1 year ahead for sales. It's fantastic, but the problem is it only goes back to, when we start collecting it. It's expensive to survey these firms. So, hopefully we'll keep going, but I'm not sure we can do this indefinitely. And, this is just data for the US. You can also get probability distributions, which is nice. You see during the pandemic, the bottom tail collapsed. It's still, the probability dispersion is quite high. People are still relatively uncertain. So, uncertainty seems a big issue. Measuring it is tricky. I think text-based approaches are pretty promising. In some ways, that's the frontier of where a lot of it is. You can use surveys, but they're expensive and they're slow to get going.